Ashish, like I believe generally when it comes to entrepreneurship, folks from top tier B schools have significant advantages. There are so many like connections that you build, which somehow help you later.
So I compare it to the nepotism thing in the film industry, right? Which is it's very easy to get in, but then it becomes very, very difficult to, I think, kind of live up to the image of everybody else. So if you look at the nepotism in the film industry, most of the star kids fail, right? So there's probably one Sanjay Dutt, one Sunny Deol against very many failures all across, right? So it's an easy foot in the door because you know people. It's probably the first conversation is relatively easier to get. But after that, it's up to you. You are as naked in the market as anyone else.
Welcome to the second episode of Create Wealth. Today we have Asish Mohapatra, founder of OfBusiness on the show. He and his wife Ruchi are known to be India's first husband-wife duo to found not one, but two unicorns. In this episode, we talk about his wealth creation journey, about how his education led him to where he is today, and what OfBusiness is likely to become in the next few decades. Listen in to this exciting episode.
Deserve presents the Create Wealth podcast with Sandeep Jethwani, featuring Ashish Mohapatra.
Ashish Mohapatra, welcome to Create Wealth. This is our second episode of Create Wealth. And one of the most interesting things about your journey is how you've gone about creating massive wealth. There are two unicorns that you've created and people barely even do one in one lifetime. When you look at your own background, there is like the brands on your LinkedIn profile or on your CV are just incredible. IIT bhi hai, ISB bhi hai, there is McKinsey, there is ITC, there is Matrix. How was this journey by design or was it by default?
Okay, firstly, thank you for having me here. My journey was a quintessential, product of the Indian education system. So, you get into the system, you are in the rat race, you win some, you lose some. If you win some, you get a good brand on your list and stuff like that. I hardly planned to, get into stuff that I ended up doing because I just ended up choosing what I thought was the best at that point in time. So I never knew that I will end up in a manufacturing factory after my time at ITC. I initially thought that I will probably do my master's. Then I realized that I'm truly desi at heart and stuff like that. I never knew that after MBA. While going into MBA, I didn't know what consulting was. I wanted to do marketing because I was a good sales guy and still stay a very good sales guy at the core. But things changed, and whatever emerged as the best possible option at that time is what I chose. I mean, to be very honest.
But Ashish, like I believe generally when it comes to entrepreneurship, folks from top tier B schools have significant advantages. We operate in a certain network. Our network allows us to raise capital. Like at least from my personal journey from IMB, there are so many like connections that you build, which somehow help you later. Okay, and like one is when you recruit folks, they look at your CV, unko lagta hai ki theek banda hoga. Second, when you fundraise, there is already an inherent advantage that you probably know the people you're going to fundraise from eventually, right? So how did that help you, or did it not, like the IIT, ISB journey?
So I compare it to the nepotism thing in the film industry, right? Which is it's very easy to get in, but then it becomes very, very difficult to, I think, kind of live up to the image of everybody else who created that kind of opportunity for you, and is actually at the very least is as an opportunity is as equal. So if you look at the nepotism in the film industry, most of the star kids fail, right? So there's probably one Sanjay Dutt, one Sunny Deol against very many failures all across, right? So it's an easy foot in the door because you know people. It's probably the first conversation is relatively easier to get. But after that, it's up to you. You are as naked in the market as anyone else. And in the market, no pedigree counts, no kind of financial backing counts. What you do, how fast you do, how high you jump, what kind of teams you build is what counts. So I think good foot in the door, but nothing beyond that.
But it's an important foot in the door, right? I mean, like half the folks would struggle to get just to the point where they can get their foot in the door, right? And then there are advantages. The other thing is like this whole consulting thing, right? And I've seen a lot of venture capitalists and founders come from McKinsey, BCG, what is it about the consulting journey that is a determinant for success in the future times?
Yeah, I think if you look at a founder, there are 3 or 4 things which are important for the founder to do well, right? And I think a couple of them at least are correlated to a initial stint at consulting. The 3 or 4 things that are important for a founder to do well, at the very minimum, there are very many things higher than that. One is the ability to think big, right? And the second is to ability to build high impact teams who are kind of gelling well with each other and are motivated around the same goal as you are, right? So I think these 2 goals in particular are the ones which are very directly correlated to consulting. In consulting, people think of very big things. I mean, one of the words that I picked up at McKinsey in my early days of my career was this word called impact. And almost everybody thought about impact right there. I mean, on the lighter side, I think the first partner that I worked with, when I asked him, what is it that you want to do in life? He said, I want to change India's GDP by 2%. That's thinking big.
Wow. That's big thinking.
That's big thinking, right? GDP. It's not like he wants to, change the course of a company or build certain wealth for each other. We're just changing GDP. So one is impact, the ability to think big. And there everybody, literally everybody, right down to the floor, actually thinks big. And the second thing is also, consulting is a very contact sport, right? You have to build followership, or else people don't work with you because they're crazy hours, right? Today, crazy hours is a big joke in the startup world. But yes, so there are crazy hours. Stuff at times is 99% or maybe even more perspiration and stuff like that. It's not stuff that you would regularly enjoy. So people have to really gel well with each other and kind of work well as a team. That consulting inherently forces you. Because of its inherent model. So I think these 2 I picked up. Other than that, there are intangible skills like how to handle yourself in big boardrooms, how to really think about the core of the problem solving issue and stuff like that. But I would say the first 2 are the ones which almost every consultant has today.
Mm-hmm. But tell me, when it comes to consulting, Ashish, one common thing is that our consultants invested enough, right? Because at the end of the day, you have to move from one event or one situation to another. Context switching is required, and you have to move away from the advice that you give, right? And only watch it. Is that something that, colors your entrepreneurial journey later on?
It does. So the reason why a lot of consultants don't end up becoming great entrepreneurs is because of what you just said, is that they're not great operators at heart, and somehow they don't believe that they can really bend the curve by themselves. So they kind of delegate well, but they don't do it themselves. So I think, so that's one vein of consulting. There are a few others as well, but rightfully pointed out, I think that's the primary reason why consultants in general tend to be very poor operators. They are very good general managers. If you see consulting or investment banking in general, like Goldman Sachs would be another example. They're typically considered the CEO factories of the world. But the great entrepreneurs are not from these 2 institutions. It's changing in India, though. I think India is a slightly different DNA compared to global institutions, meaning that India, the cream of talent actually goes to consulting in some form or the other. At least the cream of the MBA talent goes to consulting. And hence, it's more of a confounding variable that is playing in the background, which is that the best people are anyways in it. And hence, they would likely end up doing well at entrepreneurship. But globally, what you're saying is absolutely right.
Yeah, because, that's the criticism that a lot of consultants face, and for no fault of theirs, because they are being hired for a job for a limited period of time. And then when we move to your next step, which is the matrix journey, right? That's another very different position that you're in. You're somewhat invested, but even if you want to participate, you can't because you are on the sidelines, right? As a VC. And I've heard you talk about VCs who are operators, who have been operators versus VCs who have not been. Why did you get into matrix, and what was the thought process behind that? Or again, was it just like the flow of the tide which sort of...
It was, but there was a little bit more of thought into it because I had a few other opportunities as well. If you remember my first partner, he wanted to change the GDP by 1%. I said, okay, let me at least try to change it by 1 bit, if not anything else. So what happened then is that, okay, I thought, let me have real impact. And the classic joke in McKinsey was that, you were just looking at the consultant's watch, or rather your client's watch, and telling him the time, right? So you are not invested at all. We're looking at his watch and telling him the time. So I thought, okay, let me at least bridge it 1 step closer by saying, okay, let me buy him a watch At least I can look into my watch and tell him his time, right? So I
Right.
think it was one step closer to, creating real impact. McKinsey or consulting was probably two steps away. Um, at least here you can put your money where your mouth is. So it was relatively more impactful, but not really fully there. So I had kind of zeroed down on a career saying that I will rather get into operations, general management, or I didn't know PVC per se. I think I was interviewed into PVC because I was a good operator, or I was spoken of as a good operator. It just happened so that, the VC world that I entered in did not have too many operating positions as of then, and hence I ended up being a VC. It was also one of the better careers to have. I think back then, I'm talking about 2010 or so. Literally exit routes out of consulting if you're not satisfied enough. The corporate world wasn't really that open back then. It was really open at a very junior position, or it was open at a very senior position. I think mid-level positions were not really open for consultants. So you largely had to go to an investment banking or a PVC to kind of, take a step jump from there. So there were limited options back then as well.
But how was that journey at Matrix? Like what are the entrepreneurs that you were involved with? What were the experiences learning from some of them?
Right. So I think I learned more don'ts from them than do's, to be very honest, because I kind of, because of my background, both in consulting and before that, I ended up becoming a consultant into healthcare services. Now, in healthcare services, the kind of people we invested in were extremely commercial and were very clinical in nature, meaning that they had great clinical capabilities, they were great doctors, they could cure incurable diseases, they could sell their products very well and stuff like that. And at the same time, they were very commercial, right? So I think the first, I learned a series of don'ts. So I'll tell you my top 3 don'ts. The first thing I learned from them was that being commercial is not just being a good negotiator. It is also building a vision for the future. If you build something which is small and very profitable, you will end up becoming a panwala, right? The panwala actually, the panwala who sells you those betel nuts is actually the most profitable business on earth. But he just can't scale it up, right? There are no chains of panwalas per se. So one thing that I learned, and this is by virtue of getting it wrong myself, is to think big and at the same time negotiate. The second thing that I learned from them is to never overinvest. I saw a lot of healthcare entrepreneurs at that time over investing in capex, thinking that it will give them returns on margin. And it necessarily didn't play out that way because of this classic saying that, drains were never designed for downpours. Drains were designed for the fact that they would take the running water away. So if you make too big a drain, then there's probably not going to be space enough for a road. I think that's one big thing that has plagued the healthcare industry. Whenever they've got a lot of capital equity or debt, they've gone in and invested into very high capex that necessarily has not generated in returns. Some people have kind of broken this curve and stuff like that. I think the third thing that I realized is the ability to deflate your ego to build teams. So I have been with entrepreneurs who doctors particularly have extremely high egos, and that becomes an impediment in them building both clinical and non-clinical teams, meaning managerial teams as well as doctors. And I saw it really live when I saw what it could do to your culture in general, but also team building in particular. And those are the things I learned were very important to building businesses. I saw that in the absence of those, they were getting in the way of building profits or scale. And yes, I kind of used those to my own advantage when I started off.
The team one, it really resonates with me because, I feel like smarter teams which are smarter than the founder, give you a lot of leverage. It just frees up a lot of your time. And, I was recently a meeting with my marketing and my product team, and within meeting was scheduled for 1 hour. But 15 minutes ke baad, it was like, yeah, I am not required in this meeting. You guys have this covered, it seems like. So I think, and it just frees up so much of the founder's time to be able to do more productive stuff. And I think that's incredible. But talk to me about, Ashish, this whole thing about size versus profitability. 2021, 2022 has been this debate essentially, right? 2021 was about grow fast, become really big overnight, and then profitability will come at a later point of time. Now questions are being asked about how is the path to profitability, and maybe size question has become a secondary question suddenly, right? So it's like the ebbs and flows of markets. But what would be your advice to somebody who's thinking of starting up? How should they think about the size versus profitability question early on?
So in this, I have always been an extremist, almost a fundamentalist, that the fundamental of business is about making money. The whole currency of business is about handling money and handling it the right way. So I am always a profitability first person, irrespective of the kind of business that you are in. You obviously there are some businesses which have some kind of a gestation, but when I see a year of gestation, I think that I'm going to be an insomniac for a year. So I'm always profitability first. And I believe that anybody who does not think the same way has a DNA that is irreversible, right? So my thoughts would sound extremely judgmental because of the background that I come from, which was in trading, in aggregation and stuff like that. So I think that without that, the business doesn't exist. The reality is that the world is thinking about it right now because it wasn't the fad about 2-3 years back. But I guess I don't have a trade-off to be made. In my own words, I think that profitability comes first. In fact, to give you an anecdote, I actually during the first 3 years of my journey at OfBusiness had recoined the designation of mine from CEO to CPO, P not for product but P for profit, so that everybody knew that was the center of what we were aiming for. So yeah, that's who I am.
But I think it makes a lot of sense, and I think, look, long-term fundamentals of businesses don't change. Sometimes easy cash makes life different. But at the end of the day, the concept of a dhanda entrepreneur was slightly derogatory maybe a few years for the last few years, but I think it seems to be coming back. Ashish, talk to me about your own fundraising journey, because raising money at OfBusiness, which is from the outside in a non-sexy space, it's B2B. That in itself is something that is not hot in India. Generally, VCs in India have funded typically consumer businesses. What was it that allowed you to or helped you raise capital? Was it your own sales abilities, or was it your connections, or what was it that was working for you?
No, I think fundraising fundamentally, if you look at India per se, I think is much more founder first. So in India, people typically believe that the founder comes above the market. So as a founding team, not just founders, but also the senior management team, we embodied certain, I would say, capabilities or maybe certain traits which helped us. One, we were very perseverant. Two, extremely sales oriented. Three, extremely dhanda oriented. Fourth, very grounded and hands-on. Like I just ran in from a sales meeting to meet you guys on Zoom. So I think a combination of that, but people first. The second thing is our ability to have demonstrated. In the beginning, it was more people, right? So it became tougher in the first couple of years after the funding round, which was focused on people, actually went away. It was about the character of the business. Mm-hmm. I think the first 2 years when we were in business, the consumer internet was, like you said, was completely what people were infatuated or in love with, or whatever term you use. But reality is that the nature of our business looked very different, meaning that our margins were relatively lower compared to what consumer internets would do at scale. But our returns on capital were much bigger because the investment or capital efficiency for businesses like ours was very, very different. So to find out people who were interested in that was very rare, because mostly people wanted to invest into loss-making businesses who actually had a hockey stick kind of a journey to what Amazon or Alibaba initially had, right? The third thing about us is this entire thing, as you rightly spoken about. People don't think intuitively about our kind of businesses. What we sell is steel. What we sell is wood, copper, zinc, petrochemicals. People don't think about it on their daily basis, so they don't have a very intuitive sense about these products in general. So these were the obstacles. These last two were the obstacles, but I think the first one quite trumped the second and the third. And to be very honest with you, compared to all the B2B businesses that existed at that point in time, our ability to execute, especially in the beginning of our journey, was far higher, and it was visible in numbers. I'm a very numbers oriented guy. So I believe that if you have the numbers, everything else is like, will get taken care of. It's like you're studying in school and you're first in class. So your parents will kind of forgive everything else that you have. That's what happened for us.
But Ashish, like if you think about the conventional fundraising journey, right? Shuru mein it's about the founder. Then it becomes more about the execution, and finally it's fully about the business, right? And obviously every company goes through phases. Typically as the company matures or becomes like in the second or third round of funding, it becomes a lot more about the execution. Was it harder at that point of time? Because when the founder narrative weans off and it's firmly about execution, and obviously execution is not linear, right? It takes time to build. You're building the team is learning, all of that is happening simultaneously. Was it like at any point that was the challenges in fundraising also?
Our fundraising was extremely challenging. So if you leave the first round, where I think we landed money pretty easily given the founding team's background, the next two funding rounds have been it's a storied case of failure. I think 2 rounds put together, we had more than 70 plus rejections, largely because of the facts that I just told you. Nobody wanted to do B2B. There was no comparable of our business globally. People did not believe that the capital efficient nature of the business that existed at that point in time is going to continue into the future and stuff like that. So it changed. But reality is that, see, you need one investor, right? I mean, to be very honest with you, I think in our second, third, and fourth round, we've had 7 rounds so far in the company. Second, third, and fourth round, only one person liked us. So that was enough. I mean, at the end of the day, if you had one good deal, you could always negotiate your way through. I hope people who gave us that term sheet were always under the impression that we were liked by all, because they don't want to be in a what is it called, the buyer's frenzy, or what it's called, right? Yeah. So but we always found one. I think there was always one person who was there who kind of believed in our story, kind of believed the fact that these numbers are going to continue, that the scope of this business is going to be wide and stuff like that. So that is the case. I think we kept going at it, and we kept talking about the same things. It relatively got easier as the rounds progressed, because whatever numbers we kind of gave them, we kept on beating them quarter on quarter. The attrition in the top team was very low. I think margins continued to expand over a period of time. There was not a single quarter where the margins actually came down, in spite of a lot of stuff going around in the world. First it was demonetization, then it was GST, then there was credit squeezing, then there was this ILFS debacle, then there was a DHFL debacle, then there was Corona and COVID, and but the business kept marching on, and I think it got easier with time.
Yeah, and Ashish, how much was tech a part of it? Your own journey from IIT, I think, how did like your own background play an important part in how you built out the tech, or were you in that CEO position where you had strong folks? I know Bhuvan and folks like him who were building it out. So how was your own engineering background contributing to the fact that you were building a tech supported business?
See, I can proudly tell you that my engineering background, particularly the academics that I had around, though I did fairly well in my academics at that point in time, never really contributed to any kind of what I do today, except the few people I learned there and the network that I built there. See, our model in terms of senior team is very, very simple. We kind of, we operate in extreme silos. We have very common shared goals, and we kind of report to them across silos once every month or quarter, whatever the review frequencies. So I lead business. My job is to actually lead sales, because I'm a salesman at heart. Bhuvan leads tech, which includes both engineering and products. He has a very good intuitive understanding of our business. And I have a very good intuitive understanding of what technology he's building. But we never kind of, got into each other's paths. He was building what we wanted. We were consuming what he was building. And it was kind of a very symbiotic journey. I think that's very important to kind of very good people to coexist, which is that you have certain shared values and certain shared goals, but be very, very siloed or extremely independent in how you operate. So very little of my inputs have gone into technology. But what we built so far is almost treated us at par with almost all the excellent products that have been built in B2B, because we built what the customers wanted. We built where there were clear need gaps, and the business was a function of the technology.
Yeah, interesting. And one of the things which struck out to me is I was recently at this fintech event. I think you were invited, you couldn't make it. There were some very enthusiastic folks from your company there, right? And these are folks, and I think I texted you after that. These are folks who reached out to me and were talking to me about Deserve and trying to understand what Deserve does, why it does things in a certain way. And then when I was talking to them about their backgrounds, I think I realized that they are very different from your own background, right? Obviously, they are great hustlers, etc. But they were probably from tier 2 towns. They were not from the top tier 1 B schools or engineering colleges. What's been OfBusiness's story there?
Yeah, so I'm 41 and I'm probably the third or the fourth oldest person in the company. So our company is very young. Our median age is likely in the 23, 24 kind of domain. So he's probably a 2-year grad from school. So the places that I really liked as institutions, where I actually spent a lot of time professionally, were ones that were built through this entire concept of saying that we will build a management training or a good freshman program. Whether it was ITC, whether it was McKinsey, even Matrix in its earlier days, used to believe a lot in the fact that they will get people who are untrained, but who had great intrinsics, and they will kind of model them towards being a great institutional torch bearer. So that was one thing that I felt in real love with, because I had seen the opposite of it at work during my consulting and during my investing days, and I had seen that there the organizational character used to literally be something very difficult to change. It was very difficult to mold people, right? It was very easy to make people learn than unlearn. And with that concept is what we started at OfBusiness, wherein we said, okay, the founding team is probably on the wrong or the right side of 30. We were all 30 plus. But beyond that, we said we will only take people who are 0 to 2 years of experience and heavily towards freshmen. So I think more than 90% of our company is actually built with that program. It's called the management training program, wherein we take people across, variety of institutes. We go to the same institutes over and over again. And we believe that people with the right set of intrinsics, people with hunger, hustle, people who can dream big, are ready to give everything, are ready to learn, and are from tier 2 institutions, and hence loyalty comes very inherent to them because they're not thinking about the next jump and their next, how their batch is doing and stuff like that, is what we really relied on. And that's paid out for us in some ways. At least, the same guys are there, and we like hanging out with them. I know we've missed out a lot of cross company or cross institutional learning that we could have, but it's a small price to pay given where we are today.
But Ashish, isn't the learning phase a little longer for an early stage?
Lot longer. For that, you have to be really hands-on. So to be honest with you, I think the first 3 or 4 years, Sandeep, was very, very tough. Because essentially what it did was that it put a lot of pressure in the first 50 who came in, because we were a team of about 30 to 40 people who kind of started, and we were all, experienced guys. It put a lot of pressure on them to actually deliver. And in fact, during that time, all the members of our board, as well as, people who were, well-wishers of ours, they used to always come and say, hey, you know what, you're getting it wrong. Why don't you take people who can catch the ground running? But we just believed in it, because I think all of us kind of had come from some institution or the other which had that philosophy, and they had seen it out play very beautifully. And we just stuck on. It was very difficult in the beginning, and the lure to actually change it. And we fell to that lure a few times. We did hire 2 seniors, they didn't work out. And it was primarily because, they kept saying that it was very difficult to get the old boys network, as they say. So there could have been reasons for us to have done otherwise. But we just stuck to it. I think the fact is, it's not prescriptive that this is the only way.
Yeah.
But I think if you choose this way and you are disciplined about how you execute along on this way, it can really pay dividends, is my feeling.
So is it a function of the fact that you had a top tier, which was super experienced, and then there was these guys who are young and willing to be mentored by this top tier of experienced professionals, basically?
Yes. In fact, we used to sell the fact that you will be apprenticed with people who you will likely be close to in all your corporate jobs later in your careers. That used to be a big selling point on both campuses, as well as initial freshman interviews that we used to do at OfBusiness. So yes, that is something that we always banked on. The second thing that we banked on is the fact that, we sold the dream that we will never hire your boss, right? So people from your domain itself who are the best performers are the ones who are going to lead teams, maybe likely lead you in the near future. We also sold the dream that at the end of the day, we will execute to a very simple 4-step vision. The first vision is, the vision is that first year you will be a foot soldier or an executive doing whatever function you've been assigned to. The second is when you will be a team lead, the second year. And in the third year, you will be leading some kind of function or geography. The fourth year, you will be leading a business unit. And the fifth year, you will be jobless, which means you will start something new at OfBusiness. So what it did is that because we executed around this particular vision with fierce execution, I think every single year, we pushed ourselves into saying, okay, these are many number of people we've hired. Now, what do we do with them? How do they go into managing at least one new team member if they're average? Is what really people looked forward to. I think just the fierce execution around it and the fact that, very many people, like, for example, this was today our 6th year. Our third batch had close to 43 people and there were 35 left with us and almost everybody got jobless. And each of those 35 people actually got new things to do at OfBusiness is something we feel very proud about, right? And that creates a lot of management bandwidth.
No, it's incredible because in a time of high attrition, I think the strategy gives a lot of clarity to the person working in the team, because they feel that they are growing consistently and are rewarded for staying around.
As long as it's meritocratic enough.
Of course, that makes sense. Ashish, so you're already at a stage where there are 2 unicorns that you have built at OfBusiness. And I'm sure somewhere 2-3 years or maybe earlier down the line, there is an IPO. But what's really the big vision for OfBusiness? Like if you were to look at, say, 10-15 years out, what is it that you tell your team or sell to the team that this is what this company is going to become?
So to be honest with you, I am a hardwired business kind of guy. I don't think that long term. I believe that your tomorrow should be better than your today. And your day after should be better than your tomorrow. And that's how you build great businesses. I think for businesses, for me, business is about continuous improvement and thinking about it on the fly and continuously changing and iterating so that you can do it better. Having said that, I have always dreamt of this fact. I don't really share it because it sounds outlandish. I have dreamt of this fact that, that whenever there are raw materials to be spoken about, then the first name that should come to your mind is OfBusiness. I think in certain raw materials, in certain geographies, we've kind of achieved that. Yeah. But it will be great to see it pan-India. But I don't think that way. I mean, I don't execute that way. I don't speak that way. What I keep telling people is that think of it week on week, think of it month on month for sure. Never measure yourself quarter on quarter. Never measure yourself year on year, because that way you are likely reducing the ability to compound. So
why did you say that? I explain that.
So, for example, if you're measuring yourself week on week, in a year you will compound 52 times.
Yeah.
Right. Versus if you're measuring yourself quarter on quarter, you will compound yourself only 4 times. Obviously, the compounding rate in the quarter on quarter growth will be higher. But when you're compounding something 52 times, even if you're growing by 1% every week on week, that's a very 1.01 to the power 52, right? So reduce the time in which you're measuring yourself, both professionally, if you want to do it personally, even better. That is my philosophy, that, you take a number, you take a business, you take a product, you take a geography, find out what metric you want to change, and just put a very limited time frame for yourself to measure yourself on that metric. And then, over a short period of time, you then are literally chasing excellence in some way.
Ashish, you are creating wealth in many ways. I think you're creating wealth at the very beginning for the people that you serve, right? I hear it from a lot of SMEs who've dealt with you, and they talk very highly about OfBusiness. You're creating wealth for your employees, and hopefully your VCs also, and along the way somewhere for yourself as well. What does wealth mean to Ashish Mohapatra?
So for me, wealth is a way of keeping score. Beyond a point, wealth does not have any material benefits to to what we do as a living, or how much we need. I don't think we are going to hoard it forever. I don't think we are going to be very philanthropic about it. But having earned it, and earned it for a lot of people, is a great way of keeping score. It's like, when like you talked about the brands on your CV. If you've created a lot of wealth for both yourself and for others, it means that you've scored well in life.
Yeah, makes sense. What is the best investment that you've ever made, Ashish?
My best investment is investing in me. I think I am supremely confident of the fact that I will generate the best returns compared to what I would do elsewhere. So I tend to kind of put money in things that I know I can do, I can influence and stuff like that. And I've always believed that that's the best way to earn money.
That's an interesting way of thinking about it. And what was the biggest money mistake that you've made, Ashish?
I think initially in my earning years, I believed a lot in the real estate boom. And I think I locked a lot of capital out there. When this is, early part of this century, when India was going through that big kind of Shining India campaign where Vajpayee was at the helm, a lot of infrastructure was getting built. Lot of I'm a tier 2 boy myself. Tier 2 prices just scaled through the roof, right? And I made a lot of money as well during that entire boom. But what I didn't factor in for is liquidity and security. I think the amount of real estate I lost because of these two things, or the amount of money I lost, is something that I wouldn't, because you don't think about that when you're young, right? When you see prices are soaring and stuff like that, and there's like a physical asset. If you're investing money in stock, you don't see the stock, right? But if you invest money in land, you can go and walk on the land. I think that's something that I generally factor into my decisions today, which is liquidity and security, rather than just the reward part of it. And hence, real estate early in my career would be my biggest mistake.
Interesting. And what is the one advice that you would give to yourself if you were younger? What would you do differently when it comes to your money when you were younger? Would you start saving earlier? Would you have done anything different than what you did?
I would be more conservative in the beginning. I think I kind of weighted a lot towards reward in my beginning investing days. So I did a lot of stocks. I did a lot of real estate, as you just heard. I was a good stock picker because I kind of was a value investor of some kind and understood finances pretty intuitively, having done business early in life. So I think I did not understand the real concept of what is risk, and hence kind of disregarded fixed income instruments, whether they were debt funds or whether they were fixed deposits or even mutual funds at that point in time. Were very risk focused, right? So I think I disregarded risk a lot. My portfolio was always weighted towards more reward than covering for risk, and I would change that. Today, when I think of it, I think I have a fair balance, especially because I handle a lot more money at scale, right? So hence, I would probably try to imbibe some of those things early in my life, if I had a second chance.
That's amazing, Ashish. I think there are great insights for us about education, about how to build businesses, about how to start up, and finally how to manage money. This has been an incredible podcast. Hopefully, a lot of us will learn a lot from this one. Thank you for doing this, Ashish.
Thank you so much for having me.
Hit the subscribe button and stay tuned for our next episode.